Hey guys, welcome back to the channel McNallie Money, the new home of power mining analysis. In today's episode, Anthony Power and I are joined by Daniel Roberts, who's the co-founder and co-CEO of IREN. IREN has really been receiving a ton of investor attention, really since they came out with Q3 earnings back in May. They also announced an ATM program and a significant upgrade to their exahash capacity or target for year end, in addition to some significant investment in the HPC and AI sector. Now, in today's interview, we're going to be covering all of the above, plus some additional questions from the subscribers. But before we do, please take a second, smash the like button, you guys. Big help to myself and the channel. If you're not already subscribed, McNallie Money, feel free to join. And let us know in the comment section below if you're currently holding shares of IREN, what you think about these recent business developments, and how you think they're positioned compared to other miners in the Bitcoin mining sector for the back half of 2024. Now, with that being said, let's get into today's interview. Okay guys, so that's right. Today's video, we've got Daniel Roberts, the co-founder and co-CEO of IREN. It's been quite some time since Dan's been on the program. We did have a member of IREN on in the tail end of April, but since then, obviously a ton of developments with this company and really becoming probably the one single Bitcoin miner that's in the limelight right now. So Daniel, thank you so much for making time to be here. We're so excited to have you, and we've got a good list of questions from the subscribers here.
No, thanks for having us, Bryce. Anthony, pleasure to be back.
Always a pleasure. So we'll get right into it. We've got a lot to go through. We've got about an hour scheduled here with Dan. First things first, you guys came out with Q3 earnings in the middle of May there, Dan. We wanted to get a quick update in terms of some of the key highlights from that earnings release, and then we can get into some of the subsequent developments.
Yeah, absolutely. Sure thing. So around that time, so maybe stepping back, our prior guidance was for 10 exahash of operating capacity by 30 June this year and 20 exahash by the end of calendar year 2024. Around that time, the earnings call, we announced that we had brought forward the 10 exahash of operating capacity and in fact had hit it at that point in time, so about 6 weeks early. And we also upsized our year-end guidance from 20 to 30 exahash, along with outlining a transaction that we'd entered into with Bitmain for supply of those units. Predominantly S21 Pro model, so the latest generation efficiency, and once installed over the coming 6 months, would drop our fleet efficiency down to around 16 joules per terahash. So this is 510 megawatts of data center capacity. You might recall that it previously was 460 megawatts. And a couple of weeks before that earnings announcement, we actually upsized our year-end guidance for data centers. Basically, the team's got a really good run on. We've got a good cadence. We're getting ahead of the curve in terms of that delivery. And we're able to bring forward an extra 50 megawatts of capacity into the current calendar year. And that was part of helping to facilitate that upsize in year-end guidance from 20 to 30 exahash.
Amazing. And you talk about the fleet efficiency there as well. 16 joules per terahash. That's one of the lowest we've heard from any of the recent interviews we've done. How does that position IREN in a post-halving world to really maximize the output here, Daniel?
Yeah, look, it works well from two perspectives. One, it optimizes the value of your infrastructure when you've invested a lot of time, capital, and planning in building infrastructure that operates really quite efficiently. It's optimal to use the most efficient machines that you can in that infrastructure. It maximizes and optimizes the use of that infrastructure, but also in terms of cost curve. We've obviously got some pretty competitive power costs as it is, and at the current difficulty level, give or take, we're looking around $17,000-$18,000 per Bitcoin mined in electricity costs. So current Bitcoin price is about 70,000. So that sets us up for a fantastic 4-year halving epoch that we've just entered into. And yeah, it's a great platform to continue growing from.
Yeah, I mean, I looked at the results for the quarter, and we'd had, I think the week before your results came out, we had a run of all the miners with the hodls literally issuing their results day after day, and all this the gain on the valuation of Bitcoin was in their positions, and they were coming out with net incomes of 200-300 million, and record breaking periods. And then the week after, it was like all the miners coming through without the hodl, just to see what the impact was there. But it was good to see that you had a net income position post that, because some of the miners, if you take away their gain in Bitcoin valuation, didn't appear to be as good as was expected. So without that one metric being applied, it wasn't a great quarter for some of the miners. And bear in mind, we'd seen that growth in Bitcoin price from 42,000 in the beginning of January all the way up to 71,000 by the end of March. So your net income there was just over 8.6 million. The free cash flow I calculated, so looking just at the cash implications for IREN, I got you at just under 23 million. So again, that's 42% of your total revenues, which is shows that it's a strong position to be in. Obviously, this is the pre-halving position. We're coming into the next quarter by the end of June, so it'll be interesting to see some results about them. But it was good to see that, and certainly a good set of results, and also the fact that you'd raised your targets for hash rate by the end of the year. So that was unexpected, and obviously an ambitious move to make. I mean, you've got to 10 exahash before the time, but to go now to go to that 30 exahash by the end of the year. Can you just take us through, in sort of like stages, what that's going to look like over the next sort of 7 months now?
Yeah, look, obviously it was a good result on the financials. We've tried to keep it very clean. We've got no debt. We've got no Bitcoin revaluation. It's operating cash flows. And as you mentioned, 8.6 million of positive NPAT for the quarter. I think our 9 months number was about $48 million in positive operating free cash flow, which we're reinvesting into growth at this stage. So we're hoping to position the business, as we always have, as quite a clean data center mining business that's relatively easy to understand. And you do see those FASB numbers come out, and at times I feel sorry for investors having to try and interpret all that data and all the different ways different people present their financials. But we really do try to make it as transparent and as simple as possible for the end user. So in terms of raising the hash rate growth target, look, one way to think about it is just look at the end outcome, 510 megawatts of data center capacity, and then look at the models of the miners we've got and their efficiency, and you can see how you get to the 30 exahash. So we've set an average fleet efficiency of 16 joules per terahash. Multiply that by 30 exahash, you get 480 megawatts. You've then got 30 megawatts as like PUE, redundancy, and just a little bit of a buffer. So if you back solve from that perspective, you can see how we get to that. In terms of the specific trajectory to get there, we haven't disclosed a huge amount of detail at this point, other than to say 20 exahash by the end of Q3. So by the end of September, about 3.5 months time from now, we're saying 20 exahash. And then the following 3 months, there'll be another 10 exahash added to take us up to that 30. There's a combination of upgrades to existing machines in situ in British Columbia predominantly, but a little bit in Childress. So the S19J Pros. So they're 29.5 watts per terahash into per terahash, joules per terahash. In terms of efficiency, upgrading them to predominantly S21 Pros at 15 joules per terahash, you're basically getting 2 for 1.
You just basically just taking the machine out and putting the machine out. I'm assuming is it that straightforward? I'm not a technical person, but
Yep.
Yeah, pretty much. So I mean that's a real benefit, because that's not having to sort of like build as big a facilities as you needed to get to there. If you can get a machine that's operating twice as powerful, you're effectively reducing the sort of size of your core area. I mean, the great thing is we've talked about this on quite a few of our podcasts recently, is the fact that with you and Riot both having these big targets by the end of the year, it appears more manageable when you've got it all in one place to do it. And so you can probably just, as you require, bring in sufficient workforce to get that position. You've got the miners ordered, you've got the site. I believe there's some power stations probably still to be, or substations still to be, to be produced to warrant the extra hash rate that you said there. But it looks like it's all planned, and it's just going to be sort of like, a good rollout now, 20 exahash, like you say, in the last 7 months. And if you're going to get to 20 by the end of Q3, that's going to be a really good indication. So, there's peer miners out there that are growing, probably just as big a hash rate, but sort of doing it in many locations. And, we'll see the challenges of what happens there, because history tells us not everyone's going to get to the growth target. It's highly unusual that miners have actually done it before, so we do enjoy when the targets come out there and we see at the end. I mean, you guys got yours last year. CleanSpark got it the year before, but other than that, there's not many that have achieved what they've said they would do. And so this year we've got some seriously big targets, and I was impressed when it came out. I was absolutely, amazed when I saw that 30 exahash. I'm thinking that's bullish. That's where you need to be if you're going to deliver that. But you have got the site to do it. It's just a case of now getting that site fitted out. But
and maybe just to break that down a bit, there's effectively a 5.5 exahash gross up just from upgrading the S19J Pros, right? We've got 5.6 exahash. Don't quote me on that, but I am on record. It's around that, which effectively will double to around 11 exahash. So that 10 of operating capacity goes to 15.5 without us doing a thing other than unplugging some computers and plugging some new ones in.
And what's the plan with it? What would the plan? I mean, obviously they're still useful machines. They're not like, using S9, but the S19 still. Is there a plan to sort of keep them, or is there a plan that actually we can sell them and use that money to reinvest in? Because you'll still have bills to pay for some of that extra hash coming in by the end of the year. It's not you've made the deposits and everything like that, but I'm assuming there's more stage payments as you get closer to delivery for some of these mining machines.
Yeah, look, no firm decision has been made around the older units, but I would envisage we'd test the market and sell them for cash, to be honest. We're not in the interests of hodling ASICs. And if someone wants to buy them and can put them to use, then that's a fantastic opportunity for them, and we'll take the cash and continue our growth trajectory. And look, I understand that those targets look bullish and they look ambitious, but as you know, like, we don't publish something unless we're super confident that we'll at least hit it. And like, in fairness, this isn't that difficult. Like, the team, as we've said, ever since the IPO documents, and not many people listened then, and there's more people listening now, like, this team has collectively delivered tens of billions of dollars in infrastructure projects globally. To go and continue building out cookie cutter fixed design data centers, which are large buildings with preset designs, existing contractors, existing internal labor, and just be punching them out each month. Like, I'm sorry, but it's not that hard in terms of the structures, the processes that we've put in place relative to previous projects and businesses that a lot of these guys have been involved in. So for us, it's not about 30 exahash by the end of this year. Like, I spend none of my time on that, to be honest. Like, very, very little. It's a minute fraction. Like, we are thinking about next year. What are we delivering in Q1? What are we delivering Q2? What happens when our 1.4 gigawatt site is energized? What preparation can we do now in terms of building out data center infrastructure? Is that going to be data center infrastructure for Bitcoin mining? Is it going to be data center infrastructure for more AI cloud services? What happens, and this is what I'm spending more time on, what happens when we run out of power at that site? That's the 1400 megawatt site. Where do we sit in 2027, 2028, 2029? Where's our development projects? Where are the connection agreements? Do we need more land? Do we need more power? And it's always kind of thinking that 3, 5, 7 years ahead, because as we've seen, you can't click your fingers and plug a toaster into a high voltage transmission line. The world doesn't work that way, and people are learning it the hard way. We've said for years, like, this stuff takes a long time. You've got to go and find land. You've got to put in your connection request. It takes years. And what we've seen is a compounding of that process beyond our expectations in the last few years, where prior processes that might take 3 to 5 years, anecdotally, are now taking 5 to 8 years in terms of securing that power. So, okay, if it's 5 years, gee whiz, that's 2029. At least we've got a head start on a number of other development projects. That's all right. We've just got to get cracking and make sure we're not short of power in 2028.
Yeah, and I absolutely love your outlook and talking with you about this stuff. I think you're the only guy in the space that would say 30 exahash is a totally I don't want to paraphrase, but easy target. And I also love you, whether it's the financials or the way you explain your business model, you keep things extremely simple and logical and easy to follow. So I just wanted to throw that in there because it's been a while since we chatted and it's very refreshing. Now, the other thing I wanted to mention to you, Dan, a interesting fact, your BC location in Canal Flats, it's one province over from me. My wife and I actually went to look at a vacation home there. So I wanted to bring that up as well, very close to my residence. But in relation to growth, you mentioned cash, you mentioned future years and planning out. You also announced that ATM as part of that big press release with the exahash target, the earnings. Obviously, the market reacted extremely well to that in terms of share price, volume, interest in the company, and interest in this overall strategy. ATM is something we've seen work extremely effective for the miners this year. Can you talk to us a little bit about where those funds are going to be used, how far that will get you in terms of your growth forecast, and then just kind of your general ATM strategy here for 2024?
Yeah, absolutely. We need cash to grow. And I think the market's now getting comfortable with this. And what we should say is ATMs are not an issue in traditional finance. In fact, we're told by the investment banks that half, so 50% of equity capital raised in US capital markets is from ATMs. I don't think the issue is with ATMs as an instrument. I think the issue is when investors perceive that companies are using ATMs without transparency, without accountability, and perhaps not utilizing that funds for accretive growth within the company. So we've tried to be ultra transparent on that in terms of sources, uses of capital. Now, that's not to say that we're going to use the full ATM. We probably will. It's a matter of when, at what share price, right? We've seen the re-rating start to happen. I think our share price is almost 2x since the earnings announcement. And it feels like on a comparable basis, there still might be quite a little bit more room to run. But again, like, that's out of my hands to a large degree. That's Mr. Market. But the point is, when we can continue to grow at a CapEx cost of $30 million per exahash of capacity, which the market is valuing at multiples of that in terms of market value, then surely you do that all day long. Right? If you can. And this is the point you were making earlier, like, you can't. People don't have the power. They haven't got the team. They haven't got the infrastructure. They haven't got the ability to grow. And that's perhaps why there's such a disconnect between the cost of construction and the market value. And then you look at it the other way and say, well, that's the market. What are the fundamentals? And the fundamentals we've published, and we've tried to be, again, ultra transparent. 1 exahash is $30 million of CapEx. Again, at about a $65,000 Bitcoin price, and it's now higher at 70, that's a revenue line of around $19, $20 million. Electricity costs of around $4.5 million. You're at a hardware profit, so gross profit, revenue minus electricity costs, of over $15 million on a $30 million CapEx line. And that's free cash flow. That's cash that hits the bank on a revenue basis every day from the sales of Bitcoin. So you're looking at what, 15-month payback on the ASICs. and 24 months if you want to amortize both the ASICs and the infrastructure itself. So you can triangulate the metrics to work out what's accretive for shareholders. And you look at it through multiple lenses. And if you can grow, the numbers speak for themselves.
Yeah. And Anthony, we were talking about that before we started recording. So that's what Dan is referring to there, you guys. The value of this energy infrastructure. And I know IREN has been onto this for quite some time. When we had Kent on and we talked all about the AI HPC, he really beat this drum. And I think it resonated with a lot of people. But we are now seeing, as you say, Daniel, that re-rating. The market is finally starting to understand how valuable and rare and difficult this infrastructure is. Why do you think we're all of a sudden seeing this re-rating now? Is it the AI demand? Is it just that the Bitcoin mining market has now kind of disconnected from just traditional mining? They're now looking at these companies as infrastructure players, or why is this happening now?
Yeah, it's a great question, Bryce. And I think, honestly, I've been almost shocked at how public markets work. Like, I've been a private market guy my whole life, unlisted businesses. As you know, I helped set up an unlisted private infrastructure funds management business in Australia. We grew that to around 6 billion in assets under management, ports, airports, wind farms, solar farms. You build your financial model, you build your business case, you lock in your contracts, and you value it. Like, people actually believe you because you demonstrate to them that you've got all the ingredients to build out long-term infrastructure. So people discount those future cash flows back and you've got a valuation. But coming into the public markets, it's been a very different experience. It's almost the other end of the spectrum. It's, what's your next quarterly earnings number? And until I see that, I'm almost not going to believe a thing you say. And I don't know if it's skepticism around corporate CEOs and management teams and just this distrust of anything that they say. But it's been like a real awakening. And we've seen a lot of our early shareholders stay on for the ride because they believe it, they see it, they understand it. And it's not easy when the markets to sit in there going, we don't think there's value in 3,000 megawatts. We don't think there's value in the ability to grow fast when market conditions return. We don't see the value in you spending 2 years building out high voltage substations at this site called Childress for 600 megawatts when Bitcoin's $16,000 a coin. And all of a sudden the market changes and everyone goes, oh, hang on, like, there's earnings. These guys might make money. And it's like, well, we kind of haven't changed a single thing in 6 years since we said this business. We tell you every time we do something. So it has been a big surprise in that regard. But, you know, I don't make the rules. Again, it's Mr. Market. So if the market wants quarterly earnings, then bring it on. It's going to be a fun 12 months ahead.
Yeah. I mean, Dan, you've been obviously a strategy that you've utilised since I've been covering you for the last 2.5 years has been to sell your Bitcoin on a daily basis and use that funding then to grow and use it for capital expenditure, operation expenditure, rather than hodl it and go to the markets for equity or even loans. Is that still the plan going forward, or do you ever envisage a point in time where the expectation is with the Bitcoin price, if it rallies, to do what pretty much, I think it's like, say, half the miners are hodling, half the miners are probably doing exactly what you're doing there. But it's interesting to get, you know, everyone's take on it. And I know you've spoke eloquently about this before. Is that still the same position for you?
Yeah, look, it is, but we're not dogmatic. Like, I change my mind 30,000 times a day with Will, right? Like, we're always challenging our thought process. Like, how do you optimize new information, new processes, new decisions? So, you know, I'll have this conversation probably weekly with Will, and we'll just debate the pros and cons. And like, Bitcoin, my belief is Bitcoin is essentially inevitable. Once you cross that threshold and you understand that you can't create more than 21 billion and you can't stop it, it's game over. Like, this thing is just programmed to win. So, like, there is no lack of belief in Bitcoin. In fact, I actually set up a business and have dedicated the last 6 years of my life to a business that revolves around Bitcoin. So to say I'm a bear on Bitcoin is a little bit of an odd statement. But step back and you say, well, let's go back to those maths that I just outlined. If you can spend $30 million and build out an exahash of capacity that markets value in excess of $100 million, I can't buy one Bitcoin for 70,000 and have that revalued 3x, but I can if I build out this data center capacity. So what's a better use of funds? Like, clearly it seems to me that the more accretive play is to build more capacity and compound that exposure to Bitcoin for shareholders, rather than just buying a static asset and buying it on balance sheet. And yeah, until the ETFs came along, I understood that there might have been a strategy here around being a bit of a Bitcoin proxy and all in, but it just doesn't seem to be an optimal use of shareholder funds. Now, that's not to say that we won't hold some on balance sheet at some point. Personally, if we end up with a large working capital cash position, then sure, why not put some into Bitcoin if we're not going to use it? In the short term, it is a great store of value. It is a better savings tool than any checking account, savings account, treasury bond, etc. But the cash we have today is going into growth, which is turning that $30 million per exahash into $100 million per exahash for shareholders. And I just don't understand why any shareholder would want us to stop doing that and start buying Bitcoin instead. So, like, my personal thoughts are, if we're generating all this operating free cash flow and it starts becoming above and beyond our need for growth, or we want to demonstrate to the market how operating free cash flow positive we are, then look at things like distributions. Let other people hold this Bitcoin. Again, like, if I'm holding Bitcoin on your behalf, where do I put it? Do I give it to one of these unregulated offshore casinos to hold on my behalf? No. Like, we've been through the Mt. Gox. We've been through all the FTX stuff. I don't want that problem. If you hold Bitcoin, you should cold storage it. If you're not comfortable cold storage it, then go to an ETF that has all the structures, the processes, the systems in place. So my personal view is, if we are good at generating free cash flow, building out operating infrastructure and creating value for shareholders, and we wish to return some of that value to shareholders back, give it as a distribution so people can buy Bitcoin and hold it on their own behalf, or go and buy an ETF. But again, we're not dogmatic. We'll keep challenging that perspective, but that's probably where our current thinking's at.
Yeah, an excellent angle as to the non-hodl, the daily selling. And we do like to ask all the CEOs this, because there is such a contrast in this space, and there's very valid points to both sides. But I do like how you explained it. It's nothing to do with the fundamental belief in Bitcoin. It's just the return on investment and putting that capital to use, which makes complete sense to us. Now, the next question here, this has really been the hot topic over the last few weeks. It started with Riot and Bitfarms. Now we've got CoreWeave and Core Scientific. M&A in the Bitcoin mining space. Dan, we talked about this a lot last year. Our personal projection was that this would involve a lot of the private companies, but we're starting to see it creep into the public sector space as well. So I wanted to get an update, any details you can share on M&A thinking, whether that's acquiring or potentially any offers to be acquired, if you're able to share.
Yeah, look, if there's anything material non-public, we've got an obligation to disclose, clearly. But look, we've told everyone that we're exploring different options. We said it on our earnings call. We're very clear around the latent value in this platform in terms of the 3,000 megawatts of land and power, the team, its ability to execute, deliver, build everything from tier 2 through to tier 4 data center capacity. Like, there's very little this team can't do. So what does that look like? Do we sell sites? Do we enter into joint ventures? Do we build for some of the hyperscalers? Do we sell lots of stuff, including ourselves? Like, we're always open-minded. So there's lots of conversations that we're having, and we challenge ourselves on what are the best use cases for our platform and each site in it. Is it a value in use? Is it building, owning, and operating, generating free cash flow for the benefit of our investors? Is it selling it? And whatever the value maximizing path is, we'll do it. Again, we're not beholden to doing things a certain way for the sake of a belief in a certain strategy. Whatever's going to make the most money. Like, Will and I are large shareholders in this business. I think we're still the largest too. And we just want to generate value. We love what we're doing. There's multiple value creating pathways that we've got by virtue of this real asset and development platform we've created over the last 6 years. So we'll keep exploring it.
Yeah, obviously it's an interesting time, and we had the same sort of thought process in 2022 when the Bitcoin price was dropping, and they were saying there's going to be lots of M&A activity, and to be honest, we never really saw it. We've seen the sort of the HUT-8 and USBTC merger of equals effectively, and that's probably been the biggest one. There's been bits and pieces of acquisitions along the line, with distressed assets, but this news with Bitfarms and Riot obviously going in there and purchasing a significant stake in the company. Now they're the biggest shareholder in Bitfarms now. But obviously, I'm assuming as much as anything, unless the management board have 50% or more of the shares, it's down to shareholders at the end of the day on whether a decision goes through. Is it, or am I wrong in saying that?
Oh, absolutely. Shareholders own the company. It's their decision. The board is there to represent shareholders and make sure that kind of governance overlay and decision-making framework is there. And we've got majority independent board, and they're fantastic at that guiding hand and looking at everything from every angle. So yeah, look, I'll be open. Like, if we got a compelling offer, of course we're going to entertain it. But equally, we see the value in the existing platform and the team, and continuing to build out, and this hyper growth trajectory that we're on. And look, we're speaking with a lot of investors now. Like, the level of interest has really increased. Traditional funds, they're finding their ways to this sector because they're coming out from the data center shortage thematic, and they're kind of going through the process, speaking to the banks, the research houses, and saying, what does this all mean? Where's Microsoft going to get power? Where's AWS going to get power? And all of a sudden they kind of follow the breadcrumbs and say, hey, these Bitcoin miners have got lots of power. So, numerous calls with these guys. And it's interesting, right? Because I'll get on the call with one of them, and they'll have just finished a call with another mining company who, I won't name specifics, but saying the CEO said, no, Bitcoin's going to $1 million, will never sell. So, well, okay, that's kind of interesting. But like, why be so fixated in your view? And I don't know whether people just enjoy having a job and running a listed company. That's curious in and of itself. But ultimately, if you can generate a lot of value from the assets, why not? And you've got a fiduciary duty to your shareholders to do so anyway.
Is it? I'm doing it all the time. I look at the mining companies, look at the enterprise value, look at the hash rate, and you already articulated during the conversation that $100 valuation per hash rate is probably where you are at the moment in terms of what your enterprise value is today, and your hash rate of 10 exahash. And Are you sort of like doing? Are you doing in a similar way? Have you got teams there just doing the numbers on other miners just to see what's out there, potential, and just assessing every possible option is, or is it something that you don't pay too much attention
to? So I think the number the guys came up with for our quarterly earnings was 1 exahash was valued at $135 million for large scale miners, i.e. over 10 exahash. And funnily enough, I think you're right. That might correspond exactly almost with our current market cap as of today.
Well, yeah, market cap it would be, but enterprise value, because you've got a significant cash balance at the last reported level, that brings that down to probably close to 100. I mean, some of the peer miners, Marathon and CleanSpark, are getting closer to 200. So, it was sort of like running away with it from a cost value perspective. It's maybe not such a great thing when you look at it. It's great, to have that, and if the share price reflects that. And but you do see other miners, and actually other miners. I've just finished doing the analysis on the Hive Digital, and theirs is like 18 per exahash. And so when you compare 18 to CleanSpark or Marathon at nearly 200. there's a big disparity. Yours was until about a month and a half ago. Yours is really low. The fact you've now had at least some nice movement in the stock market in this last month. It's been probably you're probably in terms of growth of share price, probably the top performing miner in the last 30 days. I would suggest.
Yeah, so look, it seems to be the case that we're there now. We're at $130 million per exahash of operating capacity. We're at 10. We're adding 20 in the next 190 days. It's going to be fun on that basis.
Yeah, it should be a fun summer and fall for you guys. Now, I know we talked about the HPC, the AI infrastructure component, and the value of these data centers, but I wanted to just get a quick update on the AI cloud service portion of the company as well, the testing, the GPUs. I know you guys have announced a few previous upsizes as well in terms of the number of GPUs. What are the current developments there?
Yeah, so look, it's a strategy we're continue to be very optimistic on. It doesn't compete with Bitcoin mining. Just the power consumption is so low per unit of capex. So as we said, every $100 million of GPU capex uses less than 1% of our 510 megawatts of data center capacity that we'll have online over the next 6 months. That then generates $40-50 million of kind of hardware profit on that. So there's no opportunity cost really in terms of the infrastructure, the data center capacity. So it's really about funding and customers. And we see there's a real opportunity in this market around the cloud service. We understand a number of others are providing it. We feel like we've providing a service that is not only matching that, but anecdotally seems to be superior. And this is coming directly from customers themselves around feedback. The fact that we're 3 times faster on certain metrics than 8 other data centers, not Bitcoin miners, data centers. And there's a few reasons why we're speculating that's the case. I mean, from our perspective, we're just doing this thing properly. And then we wake up and say, oh, you guys are awesome. You're doing it really fast and efficiently. It's like, well, why is that? So I can come back to why we speculate that might be the case. But from a strategy perspective, it's just keep doing more of it. While customers want these chips, we'll keep delivering it to them and growing that side of the business. It's a fantastic return on capital in terms of the 2-year payback. However, you also need to be conscious of hardware redundancy in terms of technological improvements. It's like ASICs, right? You don't necessarily want to be caught holding older generations. So you've got the NVIDIA H100s at the moment. They're still in demand, right? There's a good revenue line attached to them, but equally there's a trajectory over the coming years for upgrades to that. Humanity doesn't still stand still. They're going to continue improving it. So how many chips do you want to buy? At what generation? What does the customer contract look like? And then what's the funding source? Sitting here today with our equity where it is in terms of market cap, the discussion we've just had, the prospect of perhaps having some very material revaluation over the coming few months as we continue to deliver more capital. Is it prudent to heavily dilute at the current levels to grow this side of the business, or is it more prudent to be a little bit patient and just allow the current potential re-rate to continue on the trajectory it's on? And then you say, well, what about debt funding? And look, debt's a double-edged sword, right? It's accretive to shareholders when it's used well, but it also increases risk. So what are the structures that look like? We saw CoreWeave raise $7.5 billion of GPU financing. We saw Lambda raise $500 million of financing. We own our data centers. There's no risk on finding data center capacity with us. So from a lender perspective, there's potentially a better credit story here from finding PowerPoints and being able to stand up this service. But what does the customer contract look like? How much risk are we willing to take on that as a business? How much risk are lenders willing to? And like I say to everyone, we're always in a rush. Like we're always trying to do everything yesterday, but we don't feel pressure to make bad decisions. We're going to take our time to make decisions that are in the best interest of shareholders. And if that means waiting an extra month, then so be it.
A few follow-up questions there, Dan. These are quick questions. on-demand service or clients in terms of
Both.
HPC? Both.
Both.
Okay.
Yeah.
You talked about payback 2 years. That's the capital expenditure of the actual GPU servers, in you.
Yep.
And so I mean, what in your own strategy, obviously I'm assuming, that the plan is to have them longer than 2 years. Otherwise it's just a pointless exercise in spending that money to not get the return. So with the 100 at the moment, in your plan, are you seeing, obviously probably 3+ years, and so you get a return, during that period of ownership?
Yeah, look, it's inherent uncertainty around it, but I think most people in the market would accept there's at least 5 to 6 years useful life out of these chips, and potentially a lot longer just with some sort of tail on the revenue. People are just going to pay a lot less in 6 years' time for these chips than they'll pay today, just because they're not going to be the latest generation.
With the current contract with Poolside, you've already announced there was an extension to that. What is that still the case at the moment? What's that looking at potentially post that extension? Are you in conversations with them?
Yep, always in conversations with them and others. Off the back of some pretty heavy testing in our facilities, they decided to enter into a contract with us initially. And then, having seen the performance of that and some of the feedback I gave you a few minutes ago, they decided to double the size of that contract and also extend the term of the contract. So we're within that contracted term at the moment, and to the extent we can agree terms for further extensions, further scale-ups, etc., then of course we're open to it.
In terms of growing, I'm assuming you've also considered lease versus buy in terms of GPUs as well, because we know Bit Digital are using that model for theirs. They're leasing facilities, leasing GPUs, and still making a profitable business out of it. Is that something you've considered yourself, or you think actually that the buy options is the best option for us?
Open-minded. We've had offers of leasing. We'll look at it on its merits and say, what's your asset liability matching? What customer contracts? And you got to remember, part of our philosophy with this business has been minimizing counterparties, because it just creates complexity and more risk within a business and just distracts you, right? So you look at the entire platform. We own the land, all the dirt. We own the concrete foundations. We own the steel data center infrastructure. We own the networking cables. We own the computers. We own and operate all the software and tech layers on top of that. Like, there's no intermediaries, no counterparties. We're not behind the meter at a wind farm. We're not leasing or subleasing a substation. We're not doing hosting. All these attack vectors, which we've seen just unstuck people over time because you have a dispute. There's a difference in objectives and incentives from different parties. And look, in theory, a vanilla lease, like sale and leaseback of GPUs, should be simple. But just the fact you've got to negotiate 30, 40 pages of documentation, you've got to have lawyers, you've got to agree commercial terms, that's a big time suck. Are we better off spending more time on the next 500 megawatt site and bringing that forward and creating an asset rather than creating a liability? That's the first question. And then you wake up the next day, you go, cool, I just got $100, $200 million of lease finance. Now I've got to live with it. There's a compliance regime. There's a provider of that lease that might have objectives that change over time. They want to get out of it. And it's like, well, all of a sudden it just kind of snowballs into this bigger deal. And that's not to say that it isn't worth doing it, but it's very easy for everyone to sit there with an Excel spreadsheet and go, oh, cost of funds is X and return on capital. It's like the real world operates a little bit more nuanced than that and complex.
Again,
two final quick questions, Dan, and I'll pass over to Bryce, but it's on HPC. First one is, obviously based in British Columbia, the weather conditions are probably more suitable there than Texas. What's this sort of like uptime in terms of service?
If it's not 100%, we ask ourselves why. It's really simple. Like, we can operate these things, and we've proven we can operate up to 111 degrees Fahrenheit. I don't think we've got a hotter temperature to be able to say we can operate hotter because it hasn't been hotter. It's very simple engineering around CFM and airflow in, chip temperatures, moving that air through the facility to keep the chips at an adequate operating temperature. So if they go down, it's like, well, why did it go down? Even things like transformers, like we underspec them, as in we overspec the capacity, because it's like engineering 101 is a bit like you take the rated capacity of anything and you operate at 80-90% of that, there's a massive efficiency gain. You never really want to be pushing up towards 100%. There's just the decline in efficiency just becomes almost exponential. So always spend a little bit of extra capital, like it's marginal in the grand scheme of things, and give yourself that redundancy. And we see that throughout the facilities. And yeah, even we get things wrong, believe it or not. Like you get things wrong every day. And what we thought was a real overspecking of these transformers, you go, oh, gee whiz, that's actually a little bit closer. So let's get this even better for the next data center we build. Let's overspec it even higher. And I think we've seen in this industry electrical issues from other companies, right? Where they say we need 1 megawatt of capacity, let's buy a 1 megawatt transformer. And if you do that and you have that mindset of just matching one for one, then you will come unstuck over time. We've seen that happen.
Final bit on HPC. We're obviously seeing, with the likes of the announcement yesterday from Core Scientific, that 200 megawatts supporting CoreWeave for the next 12 years, massive contract, guaranteed sort of revenues each year. Do you see miners more transitioning maybe into HPC space because of the predictability of revenues and earnings, where, with the likes of Bitcoin, there's probably still quite a lot of uncertainty about what's happening next week, never mind what's happening next year?
Yeah, look, at the end of the day, I'm a big believer in market forces, and investors will guide the hand of all these companies. Like, people are not running it for their own benefit. They're running it on behalf of shareholders, and those shareholders will speak. And if there is a greater value in HPC and other use cases than mining Bitcoin, then companies will be forced to explore that. And everyone will have their own view on that, right? It's subjectivity overlaid on, objective facts. And if you're sitting there in the camp that Bitcoin's going to go to $1 million and I'm never going to do an HPC deal, then that's an interesting framework. And I'm not sure how far that'll get you over the long term. But when you see those deals done with CoreWeave, on a risk return basis, it does look quite interesting, particularly if you attach that to an existing mining business and potentially get the best of both worlds. Now, remains to be seen, does Core Scientific get the best of both worlds, or do they get the worst of both worlds if they're doing both businesses in parallel? And this is a conversation we ask ourselves. But ultimately, we believe in both sectors. We believe in AI and energy intense compute. We believe in Bitcoin. We're going to pursue both. And ultimately, the market will guide us as to where they see value and how much. And if that means we need to change how our business is structured to unlock that value, because we develop large businesses in both areas, and we feel like we might be getting the worst of both worlds rather than the best of both worlds, then it's easy to make decisions and change things at that point. But our view is keep growing both sides of the business, make decisions that are clearly accretive to shareholders at each point in the process. And then when we're presented with how the investors value that, and there's a better way to value it, then we can adjust things at that point.
Yeah, I was just going to say, I just love the simple, logical answers here. I know we've covered so much today, from earnings to exahash growth, HPC, AI, ATMs. Is there anything else we haven't touched on, Dan, that you wanted to share, or any upcoming catalysts that we should keep an eye on from the IREN team?
Look, when I say I'm not spending any of my time on the 30 exahash, that's kind of not quite true. We're in conversations around delivery dates for new chips. And like always, we're trying to outperform targets that we put forward. So our hope is that we can see some more hash rate come online over the next couple of months. And that'll be nice. There's a lot of support on Twitter, or X as it's called now. We've got a lot of interested investors to continue showing that traction, and delivery will be nice. We're continuing to work on new development sites as well and grow that aspect. Yes, 3,000 megawatts is great, but why not 4? Why not 5? Why not 6,000? If not, why not? Like, it's that mentality. So we're just going to keep doing what we do and really enjoy the level of interest that we've got at the moment, the questions, and very happy to answer anything and everything.
Well deserved. Anthony's been covering IREN or Iris Energy formerly for years. And I know, Dan, we go back quite a while as well. It's so nice to finally see the market waking up, understanding, valuing what you guys are doing there, because it is such an interesting, vertically integrated, successful management team. Such a great story all around. We really appreciate the time. Anthony, I'll kick it back to you for any closing thoughts from your side, and then we can wrap up.
Two final quick questions. One is, when would you envisage breaking ground on the new site, on the other site, that the 1,400 megawatt site that you've got?
Working through it at the moment, but potentially sometime in 2025.
So final one for me is just a brief update on the NIDIG issue, if you've got a chance.
Yeah, sure. So we went through an appeal. You might recall, I think we won almost every argument in the original case. There were 1 or 2 points that fell out of it. I think the judge said a number of maybe $10 to $13 million, but I want to check that as a potential liability at the time. Notwithstanding that, we appealed it and said, we don't agree with the arguments. The contract was the contract. It was clear. Counterparty knew what they were getting into. So we appealed it. I think that appeal took place 2 or 3 months ago, and we're just waiting on the judgment of that.
Thank you.
Well, there you have it, folks. Power Hour with Daniel Roberts from IREN. We appreciate the time. It's always a pleasure. Like I say, very refreshing outlook on the space. IREN is performing really unlike any other in the sector right now. So congratulations to you and the team. We look forward to having you back. And thanks again for your time today.
No, I appreciate your support, Bryce and Anthony, and thank you for the opportunity.
Most definitely. We'll see you soon. You guys, you know the drill. If you're still watching the video, hit the like button, subscribe to the channel. And if you had any other questions for the team at IREN that we weren't able to get to today, leave them in the comment section below and we'll make sure we add them to the next interview. We'll talk soon. Thanks for tuning in, and we'll see you tomorrow.